All right, we're live-ish. Okay, a bit of housekeeping. We'll go today. Look, it probably isn't going to be a whole day, and to be honest, 8 hours of trust accounts is probably not enough for any human brain to have to put up with anyhow. So I will try and finish this stuff. Booking for this room, I'm not kidding, gave the security guys the power to open the doors to this room, but didn't include giving them authority to open the doors to the building. So they've made discretionary call to open the doors for 15 minutes. But from that point onwards, I said my swipe card didn't work in some of these doors. I don't know, has anybody tried their own card? Doesn't work? Yeah, it doesn't work. So just make note, if you do have to call them, it'll be 4781-6000. If you do need to call them to get back in, or call someone in here, we can just go and push the manual button on the door to open it. Yeah, I'll have a bit of a yarn with Jamie about that, because going through some of Terry's old classes, there's this consistent theme of difficulties that he'd had with the bureaucracy at the university, and now that I've experienced it, I'm much more sympathetic to Judge Terry. Okay, other things manually, we've got the spares of the righty stuff, those little trust account workbooks that you guys will need, and again, you can also take some spares too if you do need as well, because for your assessment, while strictly speaking, I'm never going to see the workbooks that you guys may or may not be completing, because you'll take those into your open book exam. It's definitely worthwhile to actually do them. Theoretically, you don't have to. You can just rock up to the exam and just answer the questions, but in practice, the thing will be structured in such a way that having the little workbook and doing it is going to be the key to doing well in that particular piece of assessment. Now, did anybody have any questions from yesterday as well? Things that you might want me to go over and thrash over before we carry on with this? It's all pretty much, it's accounting, a bit of law, a bit of accounting. Golden rule, don't steal your client's money. And the rules for it are really, really strict. So that key distinction, that the general trust account is in many ways sacred and sacrosanct, and the place where money goes if there's any doubt or ambiguity, because it's difficult to get money out of it quickly. Righto, so yesterday we went through the primary documents for trust accounting. What are the primary documents in trust accounting? No. They're really the secondary ones. What are the main things that you create when you're doing transactions? The main primary documents there? Receipts and check butts. Those are the two main, and deposit slips as well when you go and take the banking as well too, but that's to a lesser extent. Those are the two we call them the primary documents, because they are the ones that at the point in time when that particular transaction is done, they are the things that are created. It is at a later stage, a later point in time, where those things are moved into the payments and the receipts cash books, those two cash books. And there are also journals that can be done as well. So those three we sort of refer to as the sort of the secondary trust account material. When we start doing things like ledgers, these are really reporting instruments. They are things where we are going out to other entities or to the world and showing them what our trust accounts and what our general trust account actually looks like. That's so essentially think of these things as, I mean, I don't think they use the term sort of tertiary records, but they're certainly statements that need to be made for the benefit of other people. Be it the auditors when they come in and checking that you've got the right amount of money in your general trust account, but also for things like clients. When clients come through, the information from ledgers is what ends up in statements. And the key thing to note here, in terms of for those that are studying accounting, this control mechanisms and the risk management aspect, is the information that's copied across is cross-checked in manual systems. So the ledger balances are all plopped together onto what we call a trial balance, and then that's reconciled against what's actually in your bank account. So what do we mean by ledger? A ledger is essentially all the list of transactions for a particular matter, a particular client's matter. That's what it is. So just basically it's the balance. So if you or I have, let's say we've got a criminal law matter, we go to a particular firm, we put some money in, they spend a little money, they go and hire have to fly a witness up, or they've got to go pay a barrister, money comes out, and then sometimes we may need to put more money in. And so the sum of all of those transactions, if you think of it as a running balance, at any given moment in time, the amount that is owed to us from the general trust account is what we call the ledger balance. That's the amount that's owed to us. Yeah, there are some transactional things. It may take a little while for people to write a receipt up, or a check might take a while to clear, and so that may not perfectly align with what's actually in the bank account ready for us to grab out. And that process of really verifying those two things together, we call that reconciliation. So how do we go about creating trust ledgers? Well, essentially it's just relisting all of the transactions that relate to a particular matter, and that's essentially what it does. And the definition there for the tag that's from the Trust Accounting Guide is something that reflects that in a sentence or two. It's trying to find the correct balance for a particular client's matter at a particular point in time. The regs for ledgers. It was quite long, actually. I mean, a lot of these things, I've put either the regs or the relevant section from the LPA on the slides. But essentially, the information that goes in each line in a manual trust account ledger pretty much reflects what that particular transaction, the information that was in that. So those key things, the time that it was for, I think we've got receipts. So there we go, it's got them in separate things. Data receipts made, end of different, the date of receipt of the money, put both of those in, the receipt number, the amount obviously, the name of the person who physically walked in the door, handed the thing onto. Now you've got to appreciate, when you're doing a ledger, if you think about this, you've got a list of transactions that relate to a certain matter for a certain client. You already know what the client's name is, what their address is, what their phone number is. And so just from I guess just a practical perspective, you don't need to re-record that in each line in the ledger. It's at the top. It's at the top. You only need to do that once. For anybody here with a software background, they call it denormalization. Things that don't need to be repeated. Just put it in once. And so if you do look at the either the examples in the Trust Accounts Guide or in the little thingies that we've got there, there's a little space at the top where you can fill in the client's information once for that particular matter. And that one there, 4E, is particulars sufficient to identify the purpose for the money received. You notice that seems to be a bit of a theme. When people go, give you money for their matter, sometimes that particular packet of money can have things where you've directed them to pay out. So, this amount has to go to search fees, this amounts towards professional costs, this amounts towards stamp duty and so on. And we saw that yesterday when doing receipting and writing checks to have those things separated out. Okay, so receipts are going to be there. What else is going to be in there? What else? What other types of transactions are going to go in the ledger? Payments, and hopefully on the next page it'll have journals as well. So the check information is, again, pretty much like the receipt information. You need the check number, the date that it was done, the amount that was paid. You do where it's got a check made payable to an ADI. What's the example that we had yesterday of a check that was payable to an ADI? What's that situation in conveyancing? Yeah, that's right. It's when you're purchasing a bank check. I did get a few questions about that, so I'm just going to go over that again, the purpose of bank checks and the process of doing it. When you write an ordinary check out. As Tom would have taught us all, when I write a check, it's just an instruction for the bank to go and direct money out of this account into the account that's supposed to be paid. That's my terrible Tom Middleton impression. So it's an instruction to tell your bank to move money out of your account and give it to the person that the check's written out to, and remember all those rules, if a check's passed over to others in due course, or sometimes they're written out to cash, whatever that particular instruction is, it's an instruction to take money from our bank account. Okay? Now, what problems happen from this? Well, I might have written the check out and then gone and spent all my money at the casino. So this instruction to take money from my bank account is literally worthless. It's a worthless piece of paper. So as you can imagine, from a risk management perspective, that's a little problematic. If you're going to go and buy a house, swap the names on the titles register over, and then the check bounces, that's a bit of a problem. And so one mechanism that's been developed in this, relatively late in the piece, is rather than me writing a check out and taking the money out of my bank account as an instruction, I go to the bank and purchase an instrument. I go and say to one of the ADIs, hey, I would like to buy an instrument that looks and acts like a check, but you guys are the ones guaranteeing it, not me. So I go, call up an ANZ or whoever, and say, I'd like to buy a bank check. And they should say, sure, that'll be $250,000. And so I write my personal check out from my personal checkbook. But the target, the actual name of the entity that I'm instructing to pay is the bank itself. But when I'm buying this bank check, the whole purpose of me doing that is to give that to a third party. Hey, I want to go and buy a house. I need a bank check to do that. I'll contact the ANZ, say, hey, I'd like to buy a bank check. Here's $250,000. I'll write you a check. When that clears, then that I can take that little bank check, that instrument, to the settlement and give it to the other side. It's a document which is, at that stage, guaranteed by ANZ. They don't have to come looking to see whether there's any money in my account. I've already paid the money, which is why the example yesterday was a little bit trite. You can go and buy a bank check from another bank. Normally, you'd buy it from your own bank. Why? Because it doesn't take very long for your own bank to take the $250,000 out of your bank account when you go and you get a bank check. Whereas if you're writing it for another bank, checks take a few days to clear. So if you're going to go and do it through another bank, you'd have to wait a period of time before they would issue that bank check to you and say, here you go, we now guarantee this because you've paid us already. Does that help? Just as an instrument, like I said, and it's a much less risky way of writing checks out for doing things like settlements for large sums of money. So that's something to just leave in the back of your mind. That is the most common way of doing it. People don't usually write personal checks for buying houses, because that's fraught with danger. Okay, ledgers. So as well as having information about checks on there, it'll also have information on journals as well. Those journal transactions. Remember, what's the purpose of trust journals? It's to move money. Well, one client has multiple matters, moving money between those matters. And in theory, you could actually move it between clients if you've got written instructions. In accounting, when we use the term journals to describe the moving of amounts between accounts in the broader sense, it's a little bit of it's a lot of fudgery. It's usually, journals are usually made in accounting systems where you're trying to move balances from one thing to another. Oh yeah, the Law Society has all of these shirts, but we think they're not worth this much anymore. We think they're only worth that much. So we do a journal entry where we write this amount off. And there's a bit of discretion with that. No discretion in trust accounting. No discretion at all. The only purpose of journals in a trust accounting system is where there is clear, unambiguous written instruction from a client to move money from a matter they control to another matter. I said usually it's another matter they control, but in theory it can be another client's as well. Okay, and it should have number 7. I'll talk about electronic stuff and ETM stuff later in the day. Okay, so what do they look like? More scripts. What do they look like? All right, that's going to be the next task, by the way. Has anybody got these bits of paper? Does anyone have those things? Oh, it's going to be riveting. So you'll see in the page 2. Yeah, there we go. Trust ledger. Post all of the relevant transactions for Mr. James Arthur Brown. Now, you guys will know that this stuff mirrors, it's the same information that comes from the Trust Accounting Guide, but I've from this point onwards, I've sort of added a few bits and pieces in to make it a little bit more of an authentic task. All right, bring the thing up. And again, this is Terry stationery from the assessment piece that he's been running for years and years and years and years. Looks something like that. Sorry, it's a bit blurry. And I'll bring the headings up as well to give you guys a hand.
even more blurry.
All right. Sorry, it's a bit fuzzy. Actually, was it better on the screen yesterday? I think it was. I'm going to flick it over. I'm going to flick the screens over. So we got. Just like that. We've got an audience camera anyway. Oh, it's still fuzzy. I don't like that. Why is that so fuzzy? I should wonder whether it's. Is it YouTube settings? Is that better? Sorry, I should check that. That was my YouTube setting. And optometrists. Yeah, it should do. Trying to recoup some of the many dollars I've spent on them over the years. I wouldn't surprise me if I made it. Yeah, who's this door? balance on it. Just asking that question. What's the balance? Number on the bottom. This bit here. Every time you get something, you write it, put a line in between, and that is the running balance over there. Credits make it bigger. Receipts make it bigger. Why? Because remember when I'm talking about, yes, they're talking about statements that come from your bank. From the bank's perspective, they owe you money because you've given them the money, and at some stage that you're going to demand it back again. If you go and give your bank $10,000, you're essentially a liability. So that's why when you're reading your own bank statement, you put $10,000 in, it goes on the credit side because it's from the bank's perspective. These trust ledgers are written from the perspective of the general trust account. So if we think of it of the trust as an accounting entity, when you give them money, put money into the general trust account, it goes on the credit side because from their perspective, they can actually give it back. The trust has to give the money back at some stage in the future. Whereas when you're taking money away, it goes on the debit side. That's reducing the liability that they have to you. All right. So when you've done all of the ledgers, I'm not saying do all the ledgers for this now, but when doing a manual trust accounting task, and you've created this collection of ledger balances, what next? What's the next step? Next step is to push this button. Well, trust account ledgers and the balances are useful for the individual whose matter it is. They care about that. Hey, how much more have I still got on this particular matter? Or if it's finished, how much am I going to get back when they go and give the money back to me? But from a reconciliation perspective and a risk management perspective, what we care about as a law firm that has a general trust account is really the sum of all of the balances. Hey, if we add all of the amounts that are owed to the various clients together, in theory, that should be exactly the same as what's sitting in the bank account, right? Plus or minus a few checks that haven't been presented or money that hasn't been receipted yet. Oh, sorry, hasn't been deposited in the bank yet. So, are we good to move on from this? Oh, icy stairs. And so we call the collection of all of those ledgers on one side, so all of the balances from all of the matters, for all the money that's been paid in the general trust account, we call that the trial balance. So if you hear the phrase trial balance and you're reading it in the trust accounting guide, that is essentially what that means. It's the collection of all of the ledger accounts in a list. Added together, that amount should reconcile. A trial balance amount. And in terms of examples, this is where we flick over. We'll give the flick. We won't have no more giant James Arthur Brown. We'll move on to a different example. You can probably still use the same workbook though, because I think the trial balance stuff carries on, but it looks a little bit strange because it's one client and a couple of clients at the start, and then the back of your workbook will be a different one. Okay. And just from a mechanical perspective, a trial balance is actually one of the reporting documents. So it is something when the auditor comes along and goes, okay, let's have a look. It needs to have, as well as the name and the matter, and it's got to have that little short description as well. You have the matter code, name of the client, and the matter description, and then the amount, the balance. And what do they look like? Or something like this. Again, a lot of these examples I've just taken from the trust account guide. So if you guys do go and grab that, you can read through and see how they've gone to calculate some of them. Although I think from this part in the guide, they don't do calculations either. They're just plopping numbers on the screen. And so they look something like this. You'd have the name of the firm at the top, have the time period, and there'll be because this is a point in time return. It'll say something like as at or as of this particular point in time. with a single date. Cares about balances at a single point in time. It's not a transactional one, which shows a list of all of the transactions like we just had for the ledgers, where they've got a little running balance. At a particular point in time, the ledger balance of all of these equals this, 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 and this. Okay, and you'll notice this book at the bottom where it's got reconciled cash book balance. And we'll go through and talk a little bit about that, because the process of reconciling your physical bank statements with what the amount here is takes a few mechanical steps. Not very exciting, but it's the sort of thing you've got to learn and go and do. And you said you'll be assessed on it as well. Okay, any questions on this guy? This is probably the most important report. So if the accountant's coming through and having a quick flick, oh hey, let's have a little look. Where's your trust account at? Where are they at? Have a look at that, and then they'll go and look at the bank reconciliation as well, just to see whether the two line up. That's essentially a summary of your whole trust accounting system. Also note, I don't know if I mentioned it here, but the trial balance, which have to be done periodically, they've got to be done every month, it also has to be signed off by the principal. Not all of the accounts and every single transaction has to be signed off by a principal. That would be a bit frustrating, particularly as they get quite large. Some things do. Doing transfer journals, that must be signed by the principal. And when you're doing the reporting aspects, having the trial balance, preparing it, creating it, having it ready to go for the auditor, that has to be cross-checked and signed off by the principal of the firm. Okay.
Does that come as any extra care that the principal actually needs to check that things are correct?
Well, anything, you guys are going to be lawyers at some stage, anything you put your signature to, you are, remember contract law? Anything you sign, you've deemed to have read it. It's not, obviously not the same exact rule, but essentially the person who signs it is asserting that they've had that level of care and have checked it over. If you're signing something, you are asserting that what it is that you're signing you've read and is true and accurate to the best of your knowledge when doing it and signing it. That's the purpose of having and signing things. And that's why I'm not sure, some of you guys at the moment are working in firms and you probably get to do legal research tasks and you maybe get to do client advice and such like. When you've done your piece of advice and you're giving it off to one of the solicitors to look at, they're going to put their signature on it. Usually it won't be yours, but they'll, in my experience anyway, very carefully go through and check and vet. Mitchell's looking and going, yeah, carefully, yeah, sure they do. Because essentially, they're asserting that this has come from them. They're putting their stamp, their badge, their mark on it. And so when trouble happens, the person who signed it is the person who's going to be held responsible ultimately. And in terms of firms, the firm and the principal of the firm is the one who's going to be held accountable, because that's where the money is going to come from. If things go bad. Okay, yeah, so anyway, the only real way of checking though, yeah, you can create trial balances. They could have completely bogus fictional values in them if you've got some very naughty trust accountants in your trust accounting staff in your law firm. And so the real concrete mechanism for checking that your trust accounts are correct is by going back and checking it off against what the bank says is actually there. We call that process reconciliation, and it's a really, really important risk management step. I can't stress enough. Again, this task, by the way, is usually done by accounting people, not law people. Accountants, usually your auditors and accountants, well, accountants go through and check and do this, and the auditors check it. Oops, no, not that one. Wrong slide. Ah, my slide's wrong. That's my slide. That's my half-written slide. Just know that there are two. There are actually, no, that sentence is incomplete on the slide. Good work, Simon. There are two statements that you do. One of them is to just check the cash books, where you get all the Cashbook balances and you're essentially just writing them out, and then they check to see whether things have been deposited or not. That's a pretty basic task. The main one, though, is what we call the bank reconciliation. So you've got the Cashbook reconciliation, and then the bank or the ADI reconciliation. That's the important one. You've got to do them both because the regs say so. But particularly that checking against the physical bank statement is really the absolute key control mechanism that you have to make sure you've not done anything wrong. Okay, now here they haven't used that phrase. They've written it out in very long-winded words in the regulations here. So they're talking about the reconciling a statement reconciling the balance of the trust ledger accounts with the balance of the practice's trust account cash books. That's that first type of reconciliation, or a cash book reconciliation. And then that's under 2B sub 1. Under 2A, that's the ADI reconciliation, the actual real bank reconciliation statement that they have to prepare. Okay, note in sub 3, it's got to be done within 15 working days after the end of the month concerned. So you've got to do them each month, and then you've got to have them all ready to go. Get them reviewed, you've got to keep records, and they've all got to be signed off by people in the firm. We have to are affirming that these are true and correct. So again, going back to that statement I made yesterday about the single biggest problem that legal practitioners have, apart from mental health, we'll talk about that later, tardiness. Leaving things till the last minute is a recipe for disaster in legal practice, because things will always come up and then you miss deadlines. When you start missing these sorts of deadlines, there are consequences for us missing these things. And we know what the consequences are because we're the ones who know all about the laws. It's one of those things, but it doesn't stop us as human beings just go, meh, bugger it. Put it off till the end of the weekend. Okay. Where are we down here? Okay, so there's a series of steps we go through for each of these. Not very exciting. Not coming up on my screen. It's basically to just, this first part, this Cashbook reconciliation, is literally just going through, counting up all of the dollar items that are in the receipts page. Go through, have a look at all the receipts. Just make note, the real reason why we do this is it's really like copying and pasting the Cashbook receipts. I mean, maybe that's good as a mechanical task, that's fine. Okay, this is the amount that was actually there, sure. The only reason where this thing starts to be a little bit tricky is the beginning and the ending of the month, when things have been receipted but haven't been deposited. That's really kind of the purpose of this whole exercise. And so these things, as I said, it's a pretty simple series of steps. Just go through, count up all of the receipts that have come in this month, and just make note that the balance that you start with, it'll be the balance from your statement from the previous month. I'm not sure we even do I even do an exercise now? I don't think we do. I don't think we're even doing a Cashbook exercise. I don't think we are. It's really the whole purpose of this is to do, it's an additional check, but to be honest, it's not as important as the actual ADI reconciliation. So I didn't even put a task in, so we're not going to go through it and do this. So I just get to skip through to the other one. So there's an example, again, this comes straight from the Trust Account Guide, of going through and doing this, adding up all of the statements, and just noting that it's really to do with checking and having a statement that shows that the receipt amount is not the same as the deposit amount because of things at the beginning and the end of the month, where we've deposited something that was received in the previous month, and we've receipted something that isn't going to be deposited until the next month as well. So I don't have too much to state about that. I'm probably not going to put that in the assessment. Well, maybe I have to, but this particular task is not going to be cumbersome. What is cumbersome is this one. And there's multiple pages because you have to go through and do a mechanical series of steps. So the key thing to note when we're doing an ADI or bank reconciliation is that the numbers, when you're using checks, you guys are aware when you write a check out, it's an instruction to pay. But when you hand the check over to the other person, you have absolutely no control over when they will go take that to their own bank and get the instruction carried out to take the money out of your bank account. And so what that means is that at the end of each month, you've written some checks in the trust account, given them to people, but that change in the bank statement hasn't been shown. And so in theory, there's more money in the general trust account than what there ought to be. And so we just have to go through and appreciate that the ledger balance is going to show when something is paid, when the check is written out and given to someone. All right, but the bank statement is only going to change after that check is actually presented. What's the time limit on checks? Remember from Tom's class, what's the time limit? How long have you got to cash a check or to bank, or if you're given a check? No, it's 15 months, I think, in Australia. It's in the Checks Act. At least I think it is. I don't know. Tom's class was a little hazy for me. Checks do what's called going stale. Now, one of the curious things about this, though, if you're in business and you write a check out to pay for something and they don't cash it, do you care? 9 times out of 10, nah, paid for it. If you didn't cash it, that's the other entity's problem. With trust accounting, that is our problem. Why? Because we're holding money on trust. We write a check out and it goes stale because they haven't banked it within 15 months. We actually have a positive duty to follow up and make sure these guys actually get their money. So just make note that we're not running a business here, and that going and dealing with these things can also end up being a bit time consuming too. When you've gone and you think everything's all done, you've paid it all, do the rec, and then you're like, oh, they haven't banked that yet. Oh no, 6 months has gone by, they still haven't banked it. 12 months has gone by, yeah, probably gonna have to call them. Because there'll still be money sitting in the trust account that's ready to come out. Okay, so doing bank reconciliation, well, the first things first, make sure the rest of your books are up to date. Make sure you've actually done all of your ledgers, done all your cash books, cash payments, done all your cash receipts, and then done your journals, posted them to the ledger so that they're ready to go. All right, the next step on that is to actually go and get the physical bank statement. I've been dealing with a family law matter of my own, and I've been arguing about the need to use the actual printed physical bank statements as opposed to transaction listings. I actually think, even though I don't believe that it's written, I haven't got the regs up there at the moment, I believe that you can use a transaction listing, but I might be wrong. I might be fighting an argument that I'm going to lose, because when you are producing document from your internet banking, you guys can get your transaction listing and it's just, and you just copy it to Excel or whatever else in a useful format, or you can get the thing in what's called the printable form, which is the PDF form, which looks like the physical document that you're going through and do. And what you will find here, particularly with electronic recordings, there is actually a distinction that they make in trust accounting between those two types in terms of having them in this printable form. There's no case law on it, and let's be honest, none of us really want to go up against the QLS in terms of doing it. So I would just say, as a rule of thumb, when doing a bank reconciliation, use the PDF fancy versions that look just like the physical printed paper versions. I said it's an argument that I'm currently having, but I think I'm probably not going to win, and I could well be wrong. Anyway, I would just recommend to do it that way. I think you're just going to find it's easier too. In terms of your assessment, doesn't really matter either way. You'll be given a something that'll look very much like that, which is supposed to represent the printed statement anyhow. Okay, so once you've got that, you've got the physical statement for the month, you go and have a little look. And yeah, and so that you just go and have a look. That step 3 is just have a quick look. Oh, let's have a look. What's the Cashbook balance as opposed to our what's in the statement? Oh, look, there's a difference. And so it's going through and doing, and look, it actually takes a little bit of thought too, by the way. This is a situation where people that do this all the time, you actually get professional bookkeepers that do it, can do it quite well, with quite a low error rate and quite quickly. Us, who, odds are good that most of us won't be doing this particular task, or at least not very often, will have to take much, much, much longer because we don't do it all the time, and to just go through and carefully go through and analyze and recheck things. Because when you're doing these sorts of checks in bank statements, when money can come in, because remember, I was talking before, when you're receipting money, somebody says, oh yeah, I've sent this thing by direct deposit, all right, but with no reference. So they've sent $3,000 by direct deposit. Now, that may be the case that it was this client, but what if you had another client that was also direct depositing money that was $3,000? You've got no real mechanism for telling unless they've put the reference details in correctly. I don't know. Have you guys, like in your own lives, either personal or professional lives, had to go through this process? You've gone through, having to look through bank statements and see which bit of money came from which person? Jess, have you had to go through the bank statements of the Student Society to go through and see which bank came from which? Yeah, which one? Ah, okay. Good job. Oh, your rent money. Oh, far out. Going and checking whether your flatmates have paid rent is just the most horrible, horrible thing. Especially if they change the days. I had a massive fight, small rant, with a landlord when I was living in Auckland because I was earning a bit by that stage, and I'd started to pay the rent a few days in advance, because it used to be a bit tardy, a few days later, and I thought, I'll move it up, and move it up, move it up. And then one week I must have moved it to be a previous week, and I kept moving it forward, and then one week I'm like, oh, we had a big argument. Oh, no, I'm actually like 2 weeks ahead. No, you're not. So we had to go back over 18 months. Oh, horrible, yeah. And by the end of it, he was really angry with me. Don't know why. I'd paid him more money than... But yeah, so yeah, dealing with those things where you can't tell which bit of money came from which person is a real problem. It's a real, genuine, practical problem. Again, people that do this all the time, usually develop their own systems to go through and check and follow up these things. And that is where you've got to go back to the various the primary documents, your receipts, Cashbook. Oh, hey, we've received some money here, but we didn't receive this one. We did receive that one, didn't receive that one. And you could see why this manual accounting system works if you're not doing that many transactions. But you could imagine if you've got 4,000 clients, that this is manifestly inadequate. It just can't work. If people are putting money in, here's $1,000 there and another $1,000 in, because people are usually going to pay round numbers. Here's $1,000, there's $3,000, there's $2,000. Whose is whose? And because, remember, we're the ones now entrusted with this money in the system, and we're ultimately responsible for this. It becomes our problem. So that's something to just be very mindful of when going through and doing this. So, again, look, for the purposes of this, when doing your assessment, it's not going to be that tricky. It's not going to be that hard, but it's, it is not uncommon for things to come up and just say, DD, it's just DD, no reference at all, and it's like got a thing there, or some miscellaneous DD law or legal matter, or something along those lines, where which might be perfectly understandable for the person putting the money in. Oh, DD, Allen Bond law. The person putting the money in is, oh, Allen Bond, I'm paying Allen Bond law. But from the perspective of these ones, they don't care. They want to see the person's name. But yeah, your assessment task won't be that hard. Okay, so we do, so you find the receipt entries that line up, and then, we've got to go through, and if we go and grab a copy of the workbook. It's kind of done as a step-by-step thing. it's got, you know, first of all, we fill in the period bit at the top, and it's this idea of outstanding deposits and receipts. So you're going to have things that are in the ADI or the bank statement that are not in the cash book. And so it's got their, what have they written? In a list headed receipts, etc., and approved ADI statements. I wonder if the Trust Accounting Guide has that exact words, but yeah, that doesn't. This came from the Trust Accounting Guide. And so I'm curious to see whether or not their own guide actually aligns with their own template. We'll see. Receipts, etc., an approved ADI statement not in Cashbook. Oh yeah, yeah, it's got that about halfway down. Oh, the order they haven't done in the same way. So they've got the outstanding deposits at the top, and then they've got address about halfway down. Items approved ADI statement not in Cashbook. And look, it's a little bit tricky. This is a bit contrived because you can't move things around, and you don't have often the appropriate amount of space because you'd need, you might have one item or you might have 30. And so they're a little bit contrived, but this, for the purpose of your assessment, will be sufficient to write it in, and that's by design. It's the same with the other bits earlier as well. So your ledgers, for example, you will not need more than 6 ledger accounts because there's only space for 6 in the thing there, so that'll be the most that you'll need. Okay, unreceipted deposits. It's going to look something, and again, this comes straight from the tag. Once you've done this on both sides, it'll come down, list all of the checks that are outstanding. You've got outstanding deposits and receipts. Is that readable? Oh, not really. So things that have been received, things that have been received there but haven't been banked until later, so that's going to not align with your cash book. And then after and below that, you've got things that are your outstanding checks. So checks that have been written out but not presented. So in theory, we're going to have in our bank account $35,031 more than what we're expecting to. This last thing at the bottom is interesting, where it's got bank charges debited in error. The other purpose of this statement, although it wasn't in the guide, is also to demonstrate to the auditor errors. It's not, again, not clear in the step-by-step guide, but it's this reconciliation statement is the key moment where you are showing to third parties as a reported statement, oh look, something has gone wrong. Can the bank put bank fees onto your account, on your general trust account? No. What happens if they do? You have to immediately pay that money, the amount, that bank fee, from your office account, from the firm's account, into the general trust account, and write a note explaining it, and that note explaining it has to go off to the QLS. I'm not sure whether it has to go immediately or at the end of the month. I'll check that. But you do have to record that, note it, and fix it. Bank charges can't come out of that account. Occasionally they do, because the bank makes a mistake. The banks are pretty good these days, because they like law trust accounts. Because remember, law trust accounts, general trust accounts don't pay interest. So from the bank's perspective, that's wonderful. But from time to time, they'll make those sorts of mistakes. And so that is also in the example that you've got here too, because the next step, and what have we got? It's 10 o'clock now. This next example is going to take, I think it's the last example we do. The last example. It is. It's actually quite a big task. So it's going to take a little time. So what I recommend is that we sort of combine that with a break as well. I'll put it up on the screen. I think what you guys can do, and we'll just basically, I'll wander around the room. But I do recommend that, and it's actually on 2 pages, so this is just the first page of the 2. You'll have to read it. It's on the sheet here. Going through and do that. I reckon we'll do that, and it's going to take, like I said, we'll probably give it an hour, 45 minutes to an hour. And I do recommend that we combine that with a bit of breaks too, so if you do want to get some food, to go through that as well. So I'm going to give you guys the task. and then we'll reconvene and move on to the next module at 11 a.m. Okay? Does that sound about right? It's the reconciliation, the entire task in exercise 2 in this book. So I'm going to wander around, and you guys get started having a read. I'm going to give you about an hour to do it. I said I reckon we'll do that and reconvene at 11 o'clock. I'll close the recording here for the purpose of closing the recording, and we'll restart again, kick off with the next module at 11 a.m. Okay? Sounds good.